Welcome to the Royal Ties Podcast. My name is Clark, the Financial Credit Coach, and I will be bringing you information acquired through first-hand experiences in order to help you increase your credit score, reduce interest rates, increase savings, and eliminate debts. Doing it for the community, from the community, and by community I mean any and everyone who wants to learn and evolve. So let's get right into it. Welcome back to the Royal Ties Podcast, your dedicated resource for unraveling the complexities of financial literacy here in Canada. I'm Clarck Cadet, your host, eager to guide you through the world of credit. Today, we're delving into different types of credit and how they can impact your credit score. Let's follow the story of Jacob. He's a teacher in Edmonton who navigated through the maze of credit options to optimize his financial health. So we'll talk about the different types of credit. But before we jump into Jacob's story, let's lay out the landscape of credit types broadly. So credit can be divided into three different types. You've got revolving, installment, and open credit. Revolving credit. So this includes credit cards and lines of credits where you have a credit limit and can borrow up to that limit. The amount you owe each month can vary. Installment credit. These are loans with fixed payments and durations like mortgages, auto loans, and student loans. Each payment goes towards principal and interest. Open credit. So this type is less common and includes accounts like utility bills where the full balance is due each month. Let me get into the story about my boy Jacob. All right, so as a teacher, Jacob had a steady income but limited knowledge about how different types of credit could impact his financial standing. He initially used one credit card and a student loan to manage his finances. Wow. Now, let's talk about his journey. So Jacob's journey into the world of credit began when he decided to buy a new car and later a home. So this led to him exploring different types of credit, obviously. So credit cards, revolving credit. Jacob already had a credit card, which he managed well, never exceeding 30% of his credit limit. You guys heard that one before, right? And he always paid on time. However, he didn't realize the potential impact of opening another credit card. Auto loans, so that's an installment credit. When Jacob applied for an auto loan, he was introduced to the concept of installment credit card. He found that making consistent on-time payments positively affected his credit score. I know you guys heard that one before. It's all I yell and scream about, right? Expanding credit. Listen, pay attention to this one now. As Jacob's needs grew, he continued to expand his understanding and usage of various credit types. Home mortgage. Buying a home was a significant step. The type of credit added diversity to his profile, which is viewed favorably by credit models. Think about it. It's in his favor to have a different type of credit. Lines of credit, revolving. Later, Jacob considered a line of credit to fund home renovations. Managing this new line of credit wisely helped improve his credit utilization ratio, a key factor in credit scoring. It's key. Anyways, we'll get back to that. Managing multiple credit types. Handling multiple types of credit was a challenge at first. Jacob learned the importance of keeping the balances low on his revolving credits and the impact of installment loans on his debt levels. Credit mix and score impact. So here's where I want to break it down for you. By diversifying his credit types, Jacob improved his credit mix, which makes up about 10% of his credit score. The diversification helped stabilize his score even when he faced large expenditures. So he had a large balance, but because he had a mix, it kept his stuff low. Pay attention. Over time, Jacob's responsible use of credit not only boosted his score, but also provided him with financial flexibility. He learned to adjust his strategies according to life's demands while maintaining a healthy credit score. Strategic credit use. See, Jacob strategized his credit use by prioritizing low interest rates and better terms, understanding that not all credit is equal in terms of cost. Not all credit is equal in terms of cost. 22% on your interest rate for your credit card, 9% of your line of credit, $20,000, $800, $180. I'm just giving you the numbers. Anyways, whether it's revolving, installment, or open credit, each plays a unique role in shaping your financial landscape. Make sure you pay attention to your loans. Make sure you know what you're doing. And if you don't, talk to a financial credit coach. I know a guy, he's amazing. He's the best in Canada, and I'm him. So reach out to me, www.clarkcadet.com. Thank you for joining us for this episode. Welcome to the Royal Ties Podcast, and we'll see you again soon. My name is Clark, the financial coach, and my motto is simple: pay attention or pay for lack of attention. Please follow me at Clark, the financial coach on Instagram.